You've seen the headlines, right? MicroStrategy's giant pile of Bitcoin. But have you ever stopped to think, how in the world does that actually work? It's way more than just buying and holding. It's a machine, a really sophisticated financial machine. And today we're going to take that machine apart piece by piece. We're going to reveal what's called the Saylor stack. So let's just imagine for a second, you're in a room with the person who designed this whole thing. You get one question. What do you ask? I bet it would be something like this. Okay, forget the headlines, forget the simple version. Tell me, how does this thing really work? Well, guess what? This entire explainer, it's the answer to that exact question.
All right, so to really get how this machine works, you have to start at the bottom with the foundation, because there's this one core, totally non-negotiable rule that holds the whole thing up. Without it, none of this is even possible.
And that rule is this. The base layer is what's called unencumbered Bitcoin. Now, what does that even mean? It's actually pretty simple. It means the Bitcoin itself is never put on the line. It's not pledged as collateral in a way that could trigger a forced sale if the price drops. No margin calls, no liquidation triggers, none of that scary stuff. It just sits there, safe, totally separate from all the leverage that gets built on top of it. And look, this is the most important part to get. The asset, the Bitcoin, can never be forced to sell, ever. It's not on anyone else's clock. And because you've taken that risk of a forced sale completely off the table, the whole strategy can just ride out the crazy volatility of the market. That is the secret sauce. That's the key to the whole thing's resilience. Okay, so we have this unbreakable foundation, right? The Bitcoin is safe. The big question is, how do you build the rest of the machine on top of that? Well, let's move up to what's called the capital stack. This is where the leverage comes in.
And this is where it gets really clever. See, instead of doing the really risky thing, taking out a loan directly against the Bitcoin, the leverage is moved somewhere else entirely. It's actually baked into the financial products that are sold to investors. So the risk gets transferred away from the asset itself and onto the capital structure. It's a huge shift.
This table here breaks it down perfectly. You've got these different layers. At the top, you've got senior unsecured debt. Think of this as for the big institutions that just want a reliable, steady yield. Pretty straightforward. Then you've got convertible notes. These are a little more interesting. They offer some of that equity upside potential. And then at the bottom, you've got the common stock, the equity. Now, this layer takes on the most volatility for sure, but it also has the biggest potential reward. See? Each layer is built for a different kind of investor with a different appetite for risk. I absolutely love this quote. It's such a great way to think about it. Each layer rents a different part of Bitcoin's volatility surface. It just nails the whole idea. Instead of volatility being this big scary problem you have to manage, this whole structure flips it on its head. It turns volatility into a feature, a product you can actually package up and sell to different people. Each one of those securities we just talked about, it's basically a way to rent a specific slice of that volatility.
Okay, so we've got the foundation, we've got the structure built on top. Now, let's talk about the engine, the thing that actually makes this machine run. And here's the thing, it works in a way that, well, it might seem completely backwards at first.
I mean, think about it. Why would you issue new shares or new debt when your price is already high, right? All the conventional wisdom says buy low, sell high. But this strategy, it often does the opposite. The company issues new stuff when it's trading at a premium. It feels wrong, doesn't it? So why on earth would they do that?
Well, the logic is actually pretty beautiful when you break it down. When the company's stock or its debt is trading at a premium, they don't see it as being overvalued. They see it as a signal from the market. A big flashing sign that says, hey, we want more of this. There's excess demand for their specific way of getting exposure to Bitcoin. So what do? They give the market what it wants. They issue more securities to meet that demand, and they do it right when that capital is the cheapest for them to get. And then, and this is the most important part, they take all that cash they just raised and they turn it right back into more of that permanent, unencumbered Bitcoin for the foundation. It's a genius loop. They turn market hype into a hard asset.
Okay, this leads to a really, really important point. Let's say you decide to invest in one of these layers. What are you actually betting on? Because I promise you, it's probably not what most people think it is. Most people assume you're just making a simple bet, right? You're betting that the price of Bitcoin is going to go up next week or next quarter, but that's not the real bet here. The reality is you're betting on the system itself. You're underwriting its resilience, its clever design, and its ability to keep attracting capital over the long haul to feed that machine. So, what does that mean in practice?
means you're betting on a few key things. You're betting on the fact that the debt has a long time before it's due. You're betting on that core principle that there's no way to force a liquidation of the Bitcoin. You're betting on the equity being able to soak up those wild price swings. And maybe most importantly, you're betting that the market is going to stay interested enough to keep funding this whole operation. It's not just a bet on a number on a screen. It's a bet on the entire system. And this quote just drives that point home. The real risk isn't a price drop. The whole system is literally built to handle those. No, the real dangers are structural. What if the capital markets just freeze up one day? Or what if the company makes a huge mistake and breaks its own number one rule about never having a forced sale? As long as those basic rules of the game hold, then volatility isn't a bug, it's a feature. It's what makes the engine run. All right, let's wrap this up. We've looked at the foundation, the stack, the engine, the whole shebang. So what does the architect himself say about it? How does he sum it all up?
Boom, there it is. I'm running a Bitcoin-backed capital markets machine. I sell time, yield, and optionality, and I keep the Bitcoin. It's just perfect. The machine sells all these different financial products to investors, things like time, yield, and different kinds of options. And what does it get in return? It gets to stack and hold the real prize, the Bitcoin for the long, long haul. So after you've heard all that, after you understand how the whole system is put together, there's really only one question left to ask the guy who built it, the one question that truly matters. Okay, so which layer are you buying? And the answer is just so simple, but so powerful. Only one of them has no expiration date. Think about that. All those other layers we talked about, the debt, the convertible notes, even the equity, they're all just financial instruments. They have terms, they have structures, they have endings. But there's only one thing in this entire machine that's designed to be permanent. And that, of course, is the Bitcoin sitting right there at the foundation. A pretty telling final thought on where the real long-term bet is being made.